If you're not optimizing your S Corp salary, you might be one audit away from paying penalties in 2026. See, the IRS is doubling down on AI, and they've made it clear that unreasonable compensation is a top audit target. They're really going in on AI, and it's going to change the tax landscape going forward. So if you don't know who I am, my name's Kyle, and I've helped service-based business owners like agencies and B2B service providers save over 150 grand in taxes using a wide range of strategies. And in this video, I'm going to be breaking down the exact framework we're using in 2026 to determine how to pay yourself right, the IRS guidelines you need to follow, and the biggest red flags that are going to trigger audits. And if you're watching this and you're thinking, I have no idea if I'm doing this right, then it's time to run a tax savings assessment on your business. We'll show you exactly how to optimize your tax strategy with this and 50 plus other strategies. If that interests you, you can click the first link in the description to get started. Now, how AI is cracking down on S Corps in 2026, what the IRS is doing is they're not out here hiring thousands of auditors to manually review returns. That's the old way of how they're doing it. The new way instead is that they're deploying AI and machine learning algorithms to automatically flag suspicious tax returns. And guess what's at the top of their target list? Number one is single member LLCs filing on a 1040 and S Corp owners with unreasonable compensation. That's people in this video. The IRS, they have access to a massive data set to track this. That includes every W-2 filed in your industry, average salaries by job title, geography, historical returns, your business's revenue, expenses, and profit margins. They have advanced AI algorithms now that are comparing your S Corp return against all these different benchmarks in real time. Meaning, if anything's out of the ordinary, they're going to be able to easily catch it. And that also means that any tax strategy in 2026 and going forward, you really don't want to wing it. You really need to have rock solid documentation for anything, and I would avoid any super gray areas with it. So here's the new S Corp framework in 2026. This is how we're approaching it for service-based businesses doing $500K to $5 million per year. So the first step is the 40% rule. So this is a general guideline. I never recommend going below 40% of your net profit as salary. This is going to keep you in a safe zone, and it's a very defensible position that you can save for any audit. The next thing I do is look at industry benchmarks. So what would someone doing your job make if they were hired by another company? So for example, if you're a marketing agency owner with 5 to 10 years of experience, you'd probably be making 120K to 200K per year in another business. You can get any of this data from the Bureau of Labor Statistics, Glassdoor, or industry-specific salary surveys. The next thing I would do is I would look at role and time commitment. So are you still doing client delivery 60 hours a week? Are you really in the weeds of everything? Or have you stepped back and you're mostly focused on strategy? If you're working full time and you're the primary revenue generator, your salary, it should reflect that because you're putting more effort and time into the business. If you built a team and you're a lot more hands off, then you might be able to justify a lower salary. But that's not everybody, especially in a service-based business. And the last thing I would do is document everything. This is going to be critical in 2026 with increased IRS scrutiny with AI. What we're going to be doing is creating an audit defense file for everyone. That's going to include industry salary comparisons, job description responsibilities, hours worked, revenue generated, and how your salary compares to other employees. Just a lot of data points that if you ever get audited, you can defend yourself from it. That's going to be a huge premise and idea in this whole video. So here's some big mistakes that I'm seeing that are triggering audits in 2026. These are just different landmines that business owners might step on. So the first one is the thought of, oh, I'll just take distributions and I don't need a salary. So some owners think that they can skip the salary entirely and just take distributions. Not only is this illegal if you're actively working in the business, but the IRS is going to reclassify those distributions as wages, which is really bad because that means you can get hit with back taxes, penalties, and maybe extra interest expenses, meaning you could get hit with an extra 30 to 50K plus and penalties just for doing this. It's really not worth it, and I don't advise it at all. The other mistake I'm seeing is paying well below market rates. So I see owners paying themselves like a 40 to 60K salary when they're netting well over 500,000 a year. That's just not really smart. And the IRS's AI screening tools are going to flag these returns instantly. They're not going to pass it. If your salary is significantly below that 40% guideline I was talking about and below industry benchmarks, you're just asking for trouble. And then another mistake that I'm seeing people make is no documentation. So it's not enough to just say, this is my salary. You have to show why you chose your salary using a lot of the data that we've been talking about, job responsibilities, time tracking, things that prove why you chose that salary. And then the last one, and this one I don't see often, and is probably the biggest mistake of the four, is that they're never adjusting this as you grow. This is not a set it and forget it type thing. Your salary scales with your business. A business doing 250K a year revenue with an 80K salary is probably fine. But if that business grows to 750K per year, which I've seen a few times with people, and sometimes that can happen within 1 year, and you're still paying an 80K salary, that's not okay. The IRS is getting better and better at knowing if your business grew and what you're doing, and your salary should reflect that. This is an ongoing thing that you optimize all through the year. It's not just something you set up at the beginning of the year, and then you never do it again. Adjust it as you grow. So now, what if you have special situations? Because not every business is the same. Not every business has the owner working in it full time, or not all of them just want to hold on to it as a cash flowing asset. So what do you do in those cases? So what if you have multiple owners? So each owner who's actively working in the business, they need their own reasonable salary. You can't have one partner taking 200K and another taking 30K if they're both doing really similar work. The IRS is going to look at each owner individually. So make sure that you're keeping that in mind if you have partners that you're working with. Now, what if you're a passive owner? So this is an exception to the rule. So if you're not actively involved in the business, like actually not, you're not doing client work, you're not managing the team, you're not running the operations, then you don't have to take a salary. You can take 100% distributions in that case. But passive means truly passive. If you're still on client calls and you're making strategic decisions, that's not passive at all, and that's never going to pass. And then what if you're planning to sell in the future and exit the business? If you're setting up for an exit, this matters even more because investors look into this at the seller's earnings. And if your salary is artificially low, it's going to hurt your valuation and potential to sell in the future. So work with a tax advisor to balance tax savings with exit planning. The two of those go hand in hand together, especially doing it early on. And then for tax advantages going into the new year, there are some things that are still working in your favor. They're going to balance into how you pay yourself. So the first one is that you still have the QBI deduction. The bill that was passed in 2025 made that permanent, so it's here to stay. The tax brackets are stable, 2025 to 2026. They're going to remain at the levels they are. So this gives you predictability for planning, which is great. And then the standard deduction is higher. So if you take that, it's just going to shield more of your income from taxes. And it's just overall a good sign that you're not going to be paying as much taxes. So here's things you need to do right now if you wanted to have an action plan from this video going forward for the new year. First thing is meeting the 20% rule. Take that current salary, divide it by your net profit. If it's below 40%, you're in the audit zone and you need to change it. Next is I would have you or someone on your team pull industry salary data for your role to justify that 40% rule up there and document it. Next, I'd build an audit defense file. So this is creating a document that includes all kinds of information that proves why you took the salary. Adjust your salary if needed. So again, if you're too low, increase it before something bad happens. And if you're too high, you can always adjust it for next year, but I'd rather you be too high than too low, just so that you avoid audits, back taxes, and penalties. And then you set up quarterly reviews. Your business is going to change throughout the year. It can go up, it can go down, and your compensation strategy should reflect that. Review your profit quarterly and adjust it if needed. So that's the entire complete framework for paying yourself as an S Corp in 2026. The main takeaway that I want you to have is that AI is tightening up tax strategy going forward. It's harder to pass things by the IRS and auditors as AI is a lot smarter than all of us. Now, look, you could take everything I just gave you, you could try to figure it out all on your own. You could give it to your CPA and see if they'll do everything here for you. But here's the reality. If you get this wrong, it's going to cost you either in overpaid taxes or IRS penalties and back taxes. And that's exactly why we created our tax savings assessment. Here's exactly what's going to happen when you book a call with us and get the tax savings assessment. We're going to identify exactly where you're overpaying in taxes and where's the risk for audit. And then we're going to compile everything that we find, all of our findings, and put it into a plan for 2026 so that you have a step-by-step roadmap for where you're going. This is specifically for service-based businesses like agencies and B2B service providers doing $500K to $5 million per year who want to maximize their tax savings and build a more valuable exit-ready asset for the future. If that interests you, click the first link in the description right now to book your tax savings assessment. Let's make sure you keep more of what you earn in 2026. Thanks for watching, and I'll see you in the next video.